Investing made easy. Understanding ETFs. Are you looking to invest without the hassle of buying individual stocks? Exchange-traded funds, or ETFs, might be your answer. ETFs simplify investing by allowing you to invest in a variety of assets, like stocks and bonds, through a single fund. This means instant diversification and the flexibility to trade shares throughout the day, just like individual stocks. So what are ETFs? An ETF is an investment fund that holds a collection of assets. When you buy a share of an ETF, you gain exposure to all the assets inside. For example, a share of an ETF tracking the S&P 500 lets you invest in all 500 companies in that index simultaneously. Let's explore how ETFs work. It starts with an issuer who designs the fund and selects the assets it will hold. These assets are purchased by authorized participants, resulting in large blocks of ETF shares called creation units. These units are then divided into shares for everyday investors to buy. ETFs trade on stock exchanges, enabling real-time buying and selling, which creates a unique trading experience. Each ETF has a ticker symbol, like AAPL for Apple, allowing you to easily track its performance. Now let's see how investors earn returns from ETFs. There are two key ways to make money: capital appreciation and income. Capital appreciation occurs when the ETF's share price rises. Income is generated from dividends or interest payments from the assets within the fund. Understanding how ETFs compare to mutual funds and index funds is essential. ETFs trade like stocks with real-time pricing, while mutual funds trade once a day after market closing. Index funds are a specific type of ETF or mutual fund that tracks a market index. What makes ETFs popular is their instant diversification. With a single ETF share, you gain exposure to numerous assets, all at a low cost. They also offer tax advantages and intraday trading flexibility. However, it's important to be aware of potential risks. Price volatility, tracking errors, and the risk of an ETF closing can affect your investments. If you're ready to invest in ETFs, here's a simple 5-step guide. First, choose a brokerage that suits your needs. Consider options like Robinhood or Fidelity, which offer user-friendly platforms. Next, open and fund your account. This usually takes a few business days. Then research ETFs that match your investment goals, such as broad market or sector-specific ETFs. Once you've done your research, place your first trade using a market order for simplicity. Finally, commit to a long-term investment strategy. Reinvest dividends and stay consistent, even with small amounts. Keep in mind that ETFs may not be suitable for everyone. If you prefer picking individual stocks or need guaranteed returns, consider your options carefully. In conclusion, ETFs provide a versatile way to invest in a mix of assets. With their low costs and ease of trading, they're an excellent choice for many investors in the United States. Before diving in, weigh your options against your investment goals, timeline, and risk tolerance. If you're seeking exposure to the stock market without managing individual stocks, ETFs can be a smart move for your portfolio. Don't forget to subscribe for more financial tips and insights.